Welcome to The Explainer. Today, we're diving into a financial tool that's an absolute game changer for anyone doing business in India. We're talking about external commercial borrowings, or ECB. If you're looking to really fund your growth in one of the fastest moving markets on the planet, you're going to want to stick around for this. So, picture this. You're in India, you're ready to scale up, things are moving fast, but then you hit that classic wall, funding. It's a huge hurdle, especially when you need to get capital from your parent company overseas. So how do you actually get that cash into the country to fuel all that amazing growth? Well, for a lot of companies, the answer is the ECB. Now, on the surface, it seems super simple, right? It's just a commercial loan that an Indian company gets from a lender outside of India. But, and this is a big but, that simplicity is, well, it's pretty deceiving. And here's why. This is where we hit our first and honestly our biggest twist. Under India's foreign exchange law, FEMA, an ECB is what's known as a capital account transaction. And here's the kicker. That means, by default, it's prohibited. It's not allowed, unless it's specifically permitted by the Reserve Bank of India, the RBI. So you're not just following a rule here, you're actually operating within a special exception. So if you're working within an exception, how in the world do you navigate that? Well, the good news is the RBI has laid out a pretty clear 6-step roadmap for you to follow. Let's just quickly walk through the whole life cycle of an ECB. It all starts with your homework, the preparation phase, and consulting with your bank. Then you move into getting the contract right and getting that crucial RBI approval. But it doesn't just stop once the money's in the bank. That last step, post-management, that involves some really important ongoing reporting that we're going to talk about in a bit. And through that entire 6-step process, this is your single most important partner, the Authorized Dealer Category 1 Bank, or AD Bank. Seriously, think of them as your guide and your gatekeeper. They're the go-between for you and the RBI. They handle the mountains of paperwork, and they make sure you're compliant from day one. A strong partnership with a good AD bank is completely non-negotiable. Now, when you get to that contract stage, there are two, let's call them deal-breaker checkpoints you have to hit. First, is the interest rate you've agreed on actually reasonable when you compare it to market rates? And second, is the repayment period at least 3 years long? I'm telling you, getting either of these wrong can stop the whole process dead in its tracks. But all of this brings us to the real twist in the ECB story. You see, getting the loan approved and funded isn't the finish line. Nope. In a lot of ways, it's just the beginning of a long journey of navigating the RBI's very, very strict rules. And the stakes here are incredibly high. This isn't just some bureaucratic red tape we're talking about. If you violate the rules, you're not getting a simple slap on the wrist. No way. We're talking about the RBI demanding an immediate recall of all the funds and hitting you with potentially massive fines. The number one thing that the RBI is laser focused on is something called end-use monitoring. What that means is they scrutinize exactly how you spend every single rupee of that loan. The money can only, and I mean only, be used for the specific purpose you declared in your application. Any deviation, it doesn't matter how small you think it is a serious violation in their eyes. And this diligence, it's an ongoing commitment. You can't just set it and forget it. It all kicks off with getting a unique loan registration number, or LRN. From that moment on, you are on a very strict reporting schedule. You've got quarterly updates on how the funds are being used, and you have to file an annual compliance certificate. Missing any one of these deadlines puts your entire loan at risk. Okay, so after all that talk about rules and regulations and risks, let's get to the most powerful part of this whole explainer. Because if you do this right, an ECB is so much more than just a loan. It's about unlocking its true strategic potential. And the key, the magic key that unlocks all this potential is your status as a foreign equity holder. Now, this special status applies when the overseas lender is also a shareholder in the Indian company, like a parent company lending money to its own Indian subsidiary. This one single fact changes the entire game. So what this means is you really have two completely different ways of looking at an ECB. On one hand, you can see it as just a simple loan, to fund some basic day-to-day operations. But if you have that foreign equity holder status, it transforms into a powerful strategic tool for optimizing cash flow, not just for your Indian entity, but for the entire global corporate group. So what does that mean in practice? Well, it means you get way more flexibility in how you can use the money. It means you can start integrating your Indian subsidiary into group-level strategies like cash pooling and cash management. The ultimate goal here is to optimize your group's cash flow on a global scale and just dramatically boost your overall financial efficiency. It takes a simple loan and elevates it into a really sophisticated treasury function. So, how do you actually pull this off? How do you make that leap from just borrowing money to strategically building a financial advantage? Well, it really all comes down to three keys to success. So let's count them down. Getting this right really boils down to three fundamental pillars that are going to support your entire ECB strategy. First, it all starts with thorough preparation and really detailed planning. You can't wing this. Second, you have to build a rock-solid partnership with your AD bank. And finally, you have to commit to continuous compliance. This isn't something you can set and forget. You have to stay vigilant because these regulations are always evolving. And that really brings us to the final question that you should be asking yourself. When you look at your company's funding strategy for India, are you just borrowing money to get by, or are you using tools like ECB to build a real, lasting, strategic financial advantage in one of the most exciting markets on the entire planet? Because trust me, the difference between those two approaches is everything.